In homework 3B, question 4, I think it's question 4. Yeah, question 4. We're going to use the bond market to derive the relationship of interest rates over the business cycle. Again, we have the supply curve and we have the bond demand curve. We know this is the bond demand curve because the slope is a negative 0.26. And I'm going to change that long dash to just a shorter dash from the keyboard. And then the intercept of the supply curve, just to make sure that we know which is 707. Okay, instead of using Excel, I'm going to go ahead and use Desmos that I showed you in the previous problem, Desmos.com, to calculate the equilibrium price of the bond and the equilibrium quantity of the bonds. And that happens where demand and supply meet. So to do this, I'm going to go ahead and copy the supply curve. I'm going to get rid of these equations. I'm going to copy the demand equation. And then the equilibrium price is 887. It's the second value on the point, 887. And the quantity demanded and quantity supplied is 900. So the price is 887 and the quantity demanded is 900. And that looks about right here, right? 887 is just below 900. And then 900 is right in between the 800 line and the 1000 line. Okay, then hit enter to see if we got it right. And we did. Okay, now we got to find the interest rate, right? So again, I'm going to go ahead and delete all this stuff out here. We have a 1 period bond, and we have a discount bond, so we have a 0 coupon bond, so there's no payment. The price is $887. The face value is $1,000, and so we have to find the rate, the yield to maturity, and we can use our equation from our PowerPoint notes. We can use this equation here, which is equivalent to F minus P divided by P, which is what we have here, F minus P divided by P. And if you don't believe me, I'll show you that it's the same. We can subtract off 1 here. So we're doing it like we did in the notes, and we get 12.740%. Or we can use the rate equation from Excel, where the number of periods is 1, the payment is 0, the negative price, because we have to pay that out, is $887, and the face value is $1,000. And either way, we get the same value. So the yield to maturity, or the interest rate, is 12.74%. Okay, now we're going to graph it. Okay, so this is the supply curve. This is the demand curve. This is the quantity axis. This is the price axis. And then the equilibrium is right here. And the equilibrium quantity is 900. And the equilibrium price is 887. Okay, that's how you'd graph it. All right, so let's clear that. Okay, in this situation, suppose the economic growth rate increases, so the economy is expanding. When this occurs, firms are more willing, I think, right? They have more opportunities, so maybe they want to expand their operations, so they're more willing to borrow because they have more profitable investments. Their investments are paying off. At a given bond price, the quantity of bonds that firms will want to sell, I would say, increases, right? That makes sense. So we're holding the price constant. When we hold the price constant, we're holding the interest rates constant, right? So this increases the supply of bonds, reflected by the red equation and the red line or graph or supply curve in the graph here. Okay, that was pretty straightforward. I don't think that's all that outrageous. Growing economy, firms generally are more profitable. If they're more profitable, they want to sell more bonds because maybe they want to acquire some debt to build a factory. So they might issue 20-year bonds to expand a factory or build a distribution center or build a new factory. And so they're supplying more bonds on the market. And this generally pushes prices down, bond prices down. So the bond price is going to come down. When the bond price comes down, interest rates go up. Okay, now we got to get the new equilibrium price. And what I'm going to do is I'm just going to copy this equation into Desmos, our really handy graphing calculator. Okay, I changed the colors of the equations so they match my open math graph here. So we got two black ones, which are the initial, and then we got red supply and black demand, which is the second equilibrium. Now we're off the page here, right? So we have to adjust the width of the x-axis, and I'll change it to 2,000, and I think I'll change the y to 1,500, kind of spread it out a little better. Okay, so we want to know the equilibrium price and quantity at this new equilibrium here, where red supply crosses black demand. So the new price is 824.826. The new quantity is 1139.13. And then the equilibrium interest rate, I'll just use the rate equation from now on. Equal rate, one period bond, zero coupon payment, a negative price because we have to pay out that to get this $1,000 in the future. And the interest rate, equilibrium interest rate at this point is 21.238%. So now we can enter that information in here. The interest rate and the quantity. Hit enter, and we have the effect that economic growth has on supply, right? So let's go ahead and graph this. Our new equilibrium point right there. The supply curve, not today, but in the future one period. Let me erase that, do that a little better. Not today, but one period into the future. And then we drop straight down to get the equilibrium quantity, the new equilibrium quantity of bonds. And then we go across to get the price of those bonds in equilibrium. And then label the vertical axis, the quantity axis, the supply curve from today, the demand curve today and into the future, and then the equilibrium point. And you can see that when supply increased, the quantity of bonds increased, but the price fell. When the price falls, the interest rate rises. Okay, so that's how you'd graph it. Let's close that out and work on what happens in the demand curve, right? So we have this huge increase in supply, which makes sense because the economy is growing. Firms are more willing to borrow because they have more profitable investments. They're issuing bonds, supplying bonds in order to build new factories, build a new distribution center, or expand their operations. Now, in this scenario, it's still driven by the fact that we had economic growth increasing. Okay, so if economic growth is increasing, we, everyday Americans, just Americans in general, our wealth increases, right? Which increases the demand for bonds. And this is the new demand for bond equation. Represent red equation, downward sloping red equation, downward sloping line. And our equilibrium ends up out here. Let's go ahead and copy this into Desmos. And I've set up Desmos to give me a new demand curve in red. So the new demand curve in red has an equilibrium price of 843.522. Okay. An equilibrium quantity of 1232.609. Okay. And then we use the rate equation with a 1 year. Let me pull this out here. We use the rate equation with the 1 period bond, number of periods being 1, a 0 coupon payment because it's a discount bond, a 0 coupon bond, a negative price because we have to pay that out to get the $1,000 in 1 period. So the interest rate is 18.551%. The price is right. The quantity demanded is 1,232.609 billion. Okay. And then we graph this. Our equilibrium, our final equilibrium is right here. Our initial equilibrium is right there. The demand curve increased a little bit. I'm going to do it in blue. Maybe green. The demand curve increased a little bit, but the supply curve increased a lot. Okay, so supply increased more than demand did when we have an increase in economic growth. Okay, so let's go ahead and label the rest of the diagram. So again, this is the price, this is the quantity, this is the supply today, this is the demand today, and then this is the supply tomorrow and the demand tomorrow. So T plus 1 and t plus 1. Okay. And then you can see that the on net, the price fell. So the price fell and the interest rate rose. When the price falls. The quantity increased. Quantity of bonds increased. Okay. Now, prior to the increase in the economic growth rate, the interest rate was what? The interest rate was initially, at this black point, the interest rate was initially 12.74%. So this is the initial interest rate. Okay, and this is the final interest rate. Whoop. Prior to the increase in economic growth rate, the interest rate was equal to 12.74%. Now the interest rate equals, after the increase in economic growth, the interest rate at this red dot is 18.551%. And then the interest rate increases by this difference, right? So this is what it is at the intersection of the red supply and demand equation. And this is what the interest rate is at the intersection of the black supply and black demand equation. And interest rates increased by 5.81%. So I'm going to go ahead and close this out so I can enter the information in my open math. Okay, so the interest rate was equal to this. It is equal to that, and it increased by 5 point. Whoop. It increased by 5.81%. Okay. Now, so this model is saying that economic growth higher economic growth is going to do what? It's going to raise interest rates, right? That's what this is saying. And that's because the increase in supply was much bigger than the increase in demand. Okay? That probably makes sense, because if the economy is growing, then all these businesses are selling a lot more stuff. They want to expand their operations, so they're going to issue a lot of debt to maybe build up new factories, new distribution centers, or just expand their operations. Whereas on the investor side, the investor can invest that newfound wealth in either equity or bonds, according to the Keynesian liquidity preference theory. That's what the investor does: bonds or equity, stocks. So they have a choice. So maybe this newfound wealth is invested into buying bonds, some of it, and then some of it's put into the stock market. And then generally, when the economy is growing, people generally put their money into stocks. So under that scenario, demand would shift for bonds. Demand would shift very little relative to perhaps the supply. Okay? But it's kind of ambiguous, because what happens if the supply curve actually shifted way out here? Right? What happens if the supply curve shifted way out here instead? Well, the price would have went up a little bit, right? The price would have went up a little bit, which means interest rates would have fell. Okay, so it depends on how much supply shifts relative to demand. And we need data to kind of figure out what this ambiguous relationship is. And that's what we have down below here. Okay, down here in this graph that's from the Federal Reserve, historically what happens during an expansion, the white areas are expansion and the gray areas are recession. Okay, so historically what happens? Interest rates rise during an expansion. Interest rates rise during expansion. Interest rates rise during expansion. Interest rates, with some exception, rise during an expansion. There was a fall in interest rates during this early part of this expansion, and there was a fall in interest rates during the late part of this expansion, right? But generally, you could say that interest rates generally rise during expansions, and that that interest rates fall during recessions. Now you can actually look at early on, before we had the stagflation in the 1970s. You can see that the movement of interest rates kind of determines where the recessions start and end. It's kind of interesting, isn't it? But then things got messed up from the 1970s on. Okay, so this graph is saying that it's okay to assume that bond supply shifts more than bond demand, as this figure shows. The interest rate on the 3-month Treasury bill rising or increasing during economic expansions. Maybe increasing. Increases. How about increases? Increases during economic expansions. Okay, that's the question.